Everyone, welcome back for another deep dive.
Glad to be back.
Yeah, so today, we're going to get into a topic that's been on everyone's minds lately.
Yeah, seems like we can't go a day without hearing about it.
Exactly, the stock market and all the crazy ups and downs we've been seeing. And, we're all about getting to the bottom of things here, cutting through the noise and figuring out what's really going on. So today, we're doing a deep dive into some of the potential reasons behind this volatility, and we found one argument in particular that's really intriguing. Plus, we'll give you some broader perspective on how to think about market declines in general.
Absolutely. Context is key, right?
Always.
So the starting point for this deep dive is a recent YouTube video by Graham Stephan.
Oh, yeah, I saw that one.
Yeah, it's titled, "It's Over, Trump Purposely Crashing the Stock Market." Pretty provocative, right?
Definitely grabs your attention.
Yeah, and it's important to remember that this video presents a specific interpretation of events. And our aim here is to explore those arguments, but also give you a wider lens to view all of this through.
All right, got to see the whole picture. So let's jump right in. The first potential cause that this video highlights is tariffs.
Ah, tariffs, the word that sends shivers down the spine of global trade.
Yo, kidding. So apparently there's been this pattern developing. Trump announces new tariffs and the market initially kind of dips like it's nervous. Then it often recovers a little, like, okay, maybe it's not so bad. But then when those tariffs actually kick in, boom, another often bigger drop. And sometimes we see a little recovery if there's talk of an extension or something like that.
Yeah, it's a roller coaster anticipation, then the drop, then maybe a little climb back up.
Well, exactly. And what's really interesting and what the video really emphasizes is this potential shift in how the market is interpreting these announcements. Like at first, maybe they were seen as just negotiating tactics, part of bigger strategy. But now the argument is that the market is starting to price in the very real possibility that these tariffs are going to be sticking around for a while.
Makes sense. I mean, if you keep getting hit with unexpected costs and uncertainty,
yeah,
you're going to start factoring that into your decisions, right?
Absolutely. And the video points to some specific tariffs that are causing a lot of concern. Like, we're talking a 25% tariff on steel and aluminum imports, which has actually been in effect since March 12th. Then there's the possibility of a whopping 250% tariff on Canadian dairy and a tremendously high tariff on Canadian lumber, 250% on dairy. I mean, come on.
Yeah, that's huge. Like, think about the impact on prices for consumers and the trade relationships, the whole supply chain.
It's massive. And as the video points out, it creates a ton of uncertainty for businesses,
Wow.
right? They're trying to figure out their inventory. Like, should we stock up now before these tariffs hit? Or is that going to force us to raise prices so much that people stop buying? It's a tough call.
For sure. And I think the video rightly points out that this isn't just a one-sided thing, right? There are retaliatory measures happening too. Like, Canada has reportedly slapped a 25% tariff on electricity imports to New York, Minnesota, and Michigan. And China is hit back with 15% tariffs on American farm products. It's a trade war.
Exactly. And these kinds of back and forths can have ripple effects throughout the whole global economy, right?
Absolutely. And when you connect all this back to the bigger picture, it's easy to see why investors are getting nervous. Higher prices for consumers, a slowdown in GDP growth, fears of a recession, it all starts to feel very real.
Yeah, it's a recipe for uncertainty, that's for sure. Okay, so that's one piece of the puzzle, tariffs. But then the video gets into, well, a much more, let's say, controversial theory. This idea that this recent market downturn might not be accidental. I mean, the title itself kind of lays it out there. Trump purposely crashing the stock market. That's a pretty bold claim.
It is. There's no doubt about that. And the reasoning behind this theory, according to the video, really comes down to the national debt, which is massive, over $36 trillion and still growing. And the video highlights this one particularly worrying aspect.
Ron.
The rising cost of servicing that debt, the interest payments. It actually points out that those payments are now bigger than what we spend on defense, which is pretty mind-blowing when you think about it.
Yeah, puts things in perspective, right? So here's where the theory gets really interesting. The video emphasizes that in 2025, we've got a whopping $9.2 trillion of national debt that needs to be refinanced. And a big chunk of that, 70%, is due by June. The argument is that if the market takes a big dip, interest rates could fall, making it way cheaper for the government to refinance all that debt.
Makes sense from a purely financial perspective, I guess. Take advantage of lower rates when you have a mountain of debt to deal with.
Right. And the video actually tries to quantify this potential impact, suggesting that just a 1% increase in the interest rate on that refinanced debt could cost something like $156 for every dollar of revenue the government brings in. That's a pretty staggering number.
Yeah, you're talking hundreds of billions of dollars potentially.
Exactly. And to kind of bolster this theory, the video brings in some interesting quotes from Donald Trump, compiled by Anthony Pompano. Things like, I've been saying, let's get interest rates down, and even suggesting that a stock market decline could be a disruption. There's even one about building a strong country, which seems to put long-term economic health above short-term market gains.
It's an interesting interpretation, viewing a market downturn as a potentially calculated move to achieve some larger economic goal.
Absolutely. And the video also touches on how this might be framed to the public, right? Like maybe lower asset prices, whether it's stocks, real estate, even Bitcoin, could be spun as a good thing, as making these things more affordable for the average person.
It's a controversial idea for sure.
Yeah.
Orchestrating economic hardship for some future benefit, it's definitely something to ponder.
Totally. Okay, so that's the purposeful crash theory. But then the video shifts gears a bit to give us some really useful context about the different types of market declines, because market down can mean a lot of things, right?
It does, and it's important to distinguish between them.
Totally. So the video breaks it down into three main categories. First, we've got the stock market correction. That's defined as a drop of at least 10% from a recent peak. And what's interesting is these are actually pretty common. Since 1920, the S&P 500 has seen an average of 5% pullbacks every year and a full correction about every 16 months. The average correction is about 15.6% and lasts for roughly 71.6 days. So not fun, but not unusual either.
Yeah, it's part of the natural ebb and flow of the market, you could say.
Exactly. So a correction is a dip, but not necessarily a sign of a full-blown crisis. Then we move into more serious territory with the bear market.
Now we're talking.
Right. So what exactly makes a bear market a bear market?
Well, the definition is a decline of at least 20% from the market's previous highs. And historically, these tend to happen every 7 to 10 years on average. And they can be pretty rough. The average bear market sees a drop of around 33.2% and lasts for about 363 days. But, and this is an important point that the video highlights, those are just averages. Remember the bear market we had in 2020? Super short, sharp drop, and then a rapid recovery. Each one is unique.
Yeah, 2020 was definitely an outlier. Proves that averages don't tell the whole story. And then we have the most extreme version, the stock market collapse.
The big one.
Yeah, this is defined as a drop of at least 40% across the entire market, not just one sector or another. And the video makes it clear that these are really rare, only 3 times in the last 120 years. So, scary to think about, but statistically unlikely.
Fingers crossed it stays that way.
For sure. Okay, so that breakdown helps to put things in perspective a bit. Now, the presenter in the video also shares some of his own thoughts on how to handle these periods of uncertainty, and I thought this was really relatable. He talks about investing in real estate back in 2011, even though everyone was saying it was going to crash further, and the lesson he learned about not always waiting for the absolute bottom to jump in.
Yeah, there's always going to be someone saying, wait, it's going to go lower. But you could end up missing out on opportunities, right?
Exactly. He also really emphasizes that investing is not a game. It's not about trying to make a quick buck. He even says that overconfidence can be a real danger and that a simple, long-term approach is usually best, like investing in index funds and holding on to them. He even makes this funny comparison to dead people being good investors because they're not constantly buying and selling based on every little market move.
I love that analogy. It's so true. Trying to time the market perfectly is almost impossible, and you can end up losing more in fees and missed opportunities than you gain.
Totally. And he makes this point about how market bottoms, the lowest point, often happen when everyone is freaking out, when the feeling is that things can only get worse. It's that peak of despair that often signals a turnaround.
It's like that saying, buy when there's blood in the streets, even if it's your own.
Exactly. It's counterintuitive, but sometimes the best time to buy is when everyone else is selling.
Risky, but potentially rewarding.
Right. But the main message he drives home is that you got to have good financial habits no matter what the market is doing. Save regularly, invest consistently, don't let the ups and downs throw you off course.
Solid advice. Stay disciplined. Weather the storm.
Exactly. And he brings up this really interesting statistic. A lot of the S&P 500's biggest single-day gains have actually happened during bear markets or at the very beginning of bull markets. So if you try to sit out the downturn entirely, you might miss those big
Yeah,
rebounds.
it's like trying to dodge raindrops. You might avoid a few, but you're probably going to get soaked anyway.
Perfect analogy. And in the end, he circles back to this idea that for long-term investors, people thinking 20, 30 years down the road, these short-term fluctuations can actually be seen as buying opportunities. Like,
Yeah.
yeah, it's scary when the market drops, but it also means you can buy things at a
That's
discount.
all about perspective, right? Turning fear into an opportunity.
Totally. So there you have it. We've explored these potential factors driving market volatility, tariffs, and this interesting theory about a deliberate downturn tied to the national debt. Plus, we've given you a framework for understanding the different levels of market decline: correction, bear market, and collapse.
A lot to digest for sure.
Yeah, but hopefully it gives you some food for thought as you navigate these uncertain times. And as always, we want to leave you with a question. Considering all of this, the potential pressures on the market, the historical patterns, how are you interpreting the current economic landscape? How does all of this inform your own financial goals and strategies? It's worth taking some time to reflect on that. Thanks for joining us for another deep dive.
See you next time.